have the pleasure of having McNulty, who is a 1980 graduate of Harvard and has been in the hedge fund business for just about 20 years or so. It was around 1990 with a firm in Jacksonville called Water Street, and then since 1995 at his own firm, Trinity, at Trinity Capital. And anyway, he's talked a lot about the presentation. I promised that you guys would be full of a lot of good questions, so please don't let me down. He's looking forward to receiving them. So thank you very much. Thanks,
Dr. Brown. Appreciate it. It's great to be here. I feel like I've got to give you my Gator qualifications since I went to that, that small school up north. My parents met at the University of Florida. I grew up in Lake Mary, Florida. My parents met here because they were seated alphabetically next to each other in some class. They were a Maxwell and a McNulty, so the rest is history. I've been somebody at the lunch we had beforehand. I don't think he would have let me come in here if I didn't say I went to football games. I've been a season ticket holder for about 15 years now. So and I married a Gator, so I did as well as I could without actually earning a Florida degree anywhere. I'd like to introduce a couple of people. The guy in the orange shirt back there is my son, Court. He's a freshman year here, so I'm actually paying tuition as well. And that's my daughter, Taylor, next to him. Taylor is a junior at Northwestern, but is on spring break and would not be here, I don't think, to hear me, except that she's dating a Gator. So that's the attraction rather than listening to me. But Dr. Brown gave you the sort of the highlights of my background. Let me say that it sounds like after the lunch I said, what was the best part? What do people like hearing? It's the stories that are interesting. I have been at this probably longer than I should have, and I think I've got some interesting stories. So the outline is pretty loose. I will use that as a guideline, and there are some important things that I want to get across from that. But I'm happy to have this sort of go however it goes. So if I talk about something that's particularly interesting, feel free to raise your hand, and we'll Q&A along the way. If you can't stand it, I think I can keep us from getting too far in one direction if I don't want to. But that's fine. And along the way too, I think there's sort of some maxims, and there's. We'll get into short selling. I mean, at Water Street was a very well-known short selling firm, and I learned a lot about selling short at that point. I don't do that as much. It's still an integral part of what I do and we do, and I probably always will do for reasons I will get into, but it's not something I spend as much time on. But when we talk about that, there will be things that I know you'll be interested in that are a little different than the norm. So. Oh, but I was going to say I used to say I was going to write a book, The Top 10 Rules of Short Selling. And I have come up with a number of rules about short selling that you just have to understand, you have to appreciate if you want to be a short seller. And just about investing in general, I think there's a number of rules. And again, some of these that I'll just spit out at different times depending on what we're talking about, you will have known, you will have embraced. Some you may not have, but I think they're worth hearing. So I will say them nonetheless. I mean, like when we get into compound interest. I mean, I know you guys probably know these things better than I do, but it's what makes the world. Compound interest is what makes the investing world go round. So you need to know that. Don't know how much more of my background you'd want to know. Out of college. I did several different real estate type ventures. I did some entrepreneurial things, which is a whole. I could write a book on that. I won't talk about that. Then got into investment banking and spent 5 years in investment banking before going on to business school. And it was during that time that they changed the government changed the rules on IRAs. And you could invest up to $2,000, which was at the end of a year. I was just starting making some money, some bonus money in an investment banking firm. But still, that was about all I could muster. But you could invest it, you could deduct it, and you could grow it tax-free. Well, that got me reading about, I wanted to do that. I wanted to take my $2,000 and really do a good job with it. I started reading about other investors and what they were doing. And the more I read, the more I realized, why am I not doing what they're doing? I'm reading about Warren Buffett and John Templeton and Peter Lynch, And it was clear they loved what they're doing. They were going to do it the rest of their lives. You can do this until you die. And then I thought, gosh, if I go, and I wanted to make, I was definitely a capitalist at a fairly young age. I wanted to make a lot of money. I said, but if I go into some field and I go make a lot of money, well, the key then is, what are you going to do with that money? Where are you going to invest it? So let me kill two birds with one stone. Let me figure out how to be a good investor of that money. And if that happens to be what I'm doing most of my working day anyway, all the better. So that leads into why I felt like I should pursue a career as an investor. It just seemed like it just made a lot of sense to me. And whatever you do, I mean, whether you can't avoid, unless you're going to, go be Emerson, or Henry David Thoreau, and go live in by the pond or whatever. You can't avoid. I'm not mixing that up, Taylor. I'm getting this confused. You can't avoid not doing basic things where investing is important, like buying a house. Like wanting to know what a house is worth, like having a retirement account and wanting to know what to do with your retirement account. So investing is always going to be important. Investing as opposed to investment bank. When I got out of business school, everybody wanted to be an investment banker or a consultant, which is great. They're great jobs, and you can learn a lot. And I spent my time as an investment banker, and it's my partner now is an former investment banker. But with investing, you can do it when you want. You can do it how you want. You can do it where you want. I mean, I got tired of having it didn't matter how I tried to structure a vacation around document sessions as an investment banker. Inevitably, it was going to get postponed, and the document session that I had to be at was going to be right in the middle of my planned vacation. It always seemed to happen. So I got tired of never having my own time. As an investor, you can visit companies when you want. You can go to conferences when you want. It's an easier lifestyle, which appealed to me. And it's very stimulating. I mean, you just never know. Some of the things you learn, we were talking, some of the best investments you get, you never know where they come from. At lunch we were talking about, somehow it came up about Nintendo. Anybody who watched kids play with the Wii realized that was a huge hit. And the Nintendo, if you invested in Nintendo over the last year, you've more than doubled your money. Well, that's a pretty easy thing to say, is to realize that it was catching on. But it's fun to be able to talk to kids about. I mean, for a while I did a lot of work on video games, and teenagers couldn't understand why I knew so much about a lot of the video games that were Assassin's Creed. Why does this old guy know about Assassin's Creed and these sorts of things? But it was really interesting to figure out that Electronic Arts was a great company with several great franchises, like the Madden franchise. And to do that, you didn't do those numbers and figure out, wow, this is going to just keep doing well for a long time. And I think that stock was a 10 or 15 bagger over a number of years. But you just never know. You're at a dinner and you're talking about sleep apnea. At one point, I was doing some work on sleep apnea, and we were short Respironics, which is one of the sleep apnea companies. And it was just some guy's really intrigued when you find out he has sleep apnea, and you're asking him about his mask and how painful it is. And I know the percentage of people that have sleep apnea, and I know that what's good and bad about this. They also think you're a little weird, but it can be kind of interesting. Investing can also make or break a company. Somebody in our lunch is going to work with Wachovia this summer. Ken Thompson at Wachovia said, he lived in Jacksonville for a while. I know him. He's a neat guy. But he's really hurt that company by his acquisition of Golden West a year ago. I mean, he bought Golden West, one of the biggest mortgage companies in our country, just nearly at the peak. And not only has it crushed their earnings, but it's burdened that company with huge liabilities. Nobody knows the extent of it. So the stock's been crushed. His legacy's been tarnished, just because of a bad investment. I mean, if he'd had asked, there are a lot of short sellers who would have told him, don't fool around in the mortgage business right now. Likewise, it can be a great investment. If you followed, I'm sure everybody here tunes into YouTube. I have a 14-year-old daughter. That's all she does. She can't get her off it at night. But when Google paid $1 billion, whatever it was, for YouTube only a year or so ago. And there were a lot of, quote, smart money guys that said, that's crazy. This is two guys in their garage, and it's only been up and running for a year or two. Well, the fact of the matter is that was a brilliant acquisition. It's one of the most visited sites every day. It attracts more eyeballs, and it's really enabled them to leverage what they do well. So, again, being able to invest is, whether you're an individual or corporately or whatever, it's just always going to be something that is going to impact how you lead your life, whatever you do. So compounding. I put these up just because, again, that is you've heard the phrase, compounding is the eighth wonder of the world. And it is what really makes investing go round. If you played with these, and the white doesn't show up as well as I'd like. Some of you, I'm sure, played with these numbers. So my first question is, of the first two lines, which order would you like to have those? I mean, which return is better? Who actually plugged those into their HP12C and can figure that out? Or has a hunch? We have a vote for the first one. We have a vote for the second one. That should cover it, except they're exactly the same. Any number of any data points like that you put with annual compounding, no matter how you rearrange them randomly, it's going to yield the same return, which is worth knowing sometimes. Some people think, you never want to get off to a bad start, or because it's so hard to catch up. Some people think, well, if you get off to a bad start, it's a small amount of money, then you can make up later. I mean, unless you're changing, money flows will change that. If money is in or out along the way, then it will impact that dramatically. But for the but other than that, it's any way you string those numbers together is going to be the same. What happens in the real world, by the way, which is, speaking of stories, I can think of a couple of stories about that. I mean, often what happens is people put together good records for a 2, 3, 4 year period, and then all the money flows in, and then they do poorly. So when you look at the money that was made or lost during that period, there was a lot more money lost because the bigger money came in at the end. That's what happened in the NASDAQ bubble. You guys some of you may remember that. This was the internet mania back in the late 90s. Well, that first line there, that's the NASDAQ. I rounded it, but it's within plus or minus 2%. Each of those years, the first year is 1996, 97, 98, 99. The NASDAQ peaked in March of 2000, and then ended up being down 40% for the year, then down 20, 2000, 2001, and then in 2002, actually, as if 40 and 20% years weren't bad enough, 2002 was down 30%. And let me tell you, if you were in my business and you were long NASDAQ stocks, a lot of those guys aren't in the business anymore. I mean, it was a brutal period. It's just hard to lose. Losing 20% is no fun. Losing 20% to 40% 3 years in a row is just dreadful. So, but this gets at compounding. When you look right here, by the end of this stretch, $1 was nearly $4 after only 4 years, almost a four-bagger. By here, it was, I think it's $1.86, $1.87, and then of course losing a 30% on top of that turned it into $1.30. Well, which one of these? Well, that's an easy question. This one, 12% a year, actually slightly beats this one. This is just shy of $2, and this is like $1.86 over the 6-year period. Do you guys know the rule of 72? Anybody know? Somebody tell me the rule of 72. Somebody knows this rule. Just a good basic rule. Yeah.
You take 72 divided by the interest rate you earn, and that's the number of years it takes to double.
Exactly. That's just a good rule of thumb, okay? You take, in this case, we're earning it. It's a nice steady 12% a year. So you take 72 divided by 12, and it takes 6 years to double. It's a great rule for compounding. If past book savings are paying you 4%, 72 divided by 4 is 18. So 18 years, your money will double. It will double. It just takes a long time to do that at 4%. 10%, takes about 7 years. So there you go. In my when the whole time I've been running my hedge fund. What we've sort of a back of the envelope number we shoot for. When we look at stocks, we like to think we can double them it's a stock that can double in 3 years or triple in 5 years. Now, if you use that rule, either way, that works out to about 25% a year on the stock. 72 divided by 3 is roughly 25, right? And 72 divided by 5 is roughly 25. So, double or triple in 3 years or 5 years. Now, another thing this points out is you don't want to lose money. Losing money is just a bad thing. Now, I'll quote Warren Buffett several times, and we talked about him at lunch a little bit. The reason that any investor worth his salt will quote Warren Buffett is because he's the smartest man alive, period. You just don't have to debate that. He's the smartest man maybe ever. And although we did say some of the stuff he's buying now, you always wonder, what's he doing buying Kraft Foods? I mean, it's just so boring, some of the stuff he's buying. But Buffett has his 2 main rules for investing are rule number 1, don't lose money. And rule number 2, don't forget rule number 1. It's just an easy way to compound if you do that. Look at this. I snuck in this up 85 here, the last one. So again, these all come out to just shy of turning $1 into $2. If you can make 12% a year, and then sneak in an 85 along the way, this is 3 1/4. So just that one good year, and yet not losing money, turns this year, into from 2 into 3 1/4. So over 50% better, which is obviously very, very meaningful. The other thing that going back to the NASDAQ up at the top, when you lose money, the other reason it's so bad is if you lose 5%, not a big deal. The 100 becomes 95, but you need to make more than 5% now to make it back, right? You have a smaller denominator. It's math. But if you go from 100 to 95, you lost 5%, you need to make about 5.5%. Not a big deal. You lose 10%, 100 to 90, you need to make about 11%. But when you get into real numbers, if you lose 25%, 100 becomes 75, with me, the math, well, you got to make a third. 75, you have to make 33%, even though you lost only 25%. If you lose half your money, 100 becomes 50, you've got to double it. So you string together a bunch of up 100%, down 50%, and you're standing in place. You're not going anywhere. So that's the NASDAQ actually went. The NASDAQ went from, I told you from the beginning of '96 through '99, went from about 1,000 to just over 4,000, up almost 4 times. It was. Then by the end of the next year that you can't see, it was the end of. When it got as low as. Well, let me say it a different way. So it went to 4,000. It actually went in March of this year, right here, 2000. The 4,000 went to over 5,000. So you actually made. What happens is a lot of people came into the NASDAQ and they came into the funds, into mutual funds that were pushing NASDAQ stock. So all the money's pouring in here. You've had these years, and here's where all the money's pouring in. And actually, just from the end of this year to March, they made 25% on their money, from 4,000 to 5,000. And yet, by the end of that year, you'd lost 40%, which is often what happens. You will see that when there are manias. There's a book by Charles Mackay called "Extraordinary Delusions of the Crowd" or something. That's one of the most famous books on bubbles, and they always happen. The internet bubble was a classic. We've had it a little bit with mortgages. And what's happened it's why we have it's a really scary thing right now. What's going on with our country, because it's not just people who own stocks; it's people who own houses, and that's 3/4 of the country right now. And the bubble is bursting there, and it's unclear when that's going to stop. But there are other manias where you can just see the prices of things just go crazy and really crazy. I mean, I think we'll have one in gold before it's all said and done, and we may get into that. That's one of my favorite investments right now, even though I don't think the world's necessarily going to come to an end. I just think there's a lot of reasons gold can do really well. So it took the NASDAQ is actually, well, I'm probably pounding this too much, but you know, the next 3 years, after the down 30 year, the NASDAQ was up 50, up 10, flat, up 10, up 10. So some pretty good years there, and up 50 and 3 up 10s. And yet it's still well below. It's 20 at the end of last year. It was 2,600, well below the 4,000 it was at the end of the 85% year, which again just points out don't lose money. You lose money, you're really going to hurt your rate of compounding. Any questions on that? That's enough on that. Okay, fun stuff. I bet we have poker players in here. I bet we've got some blackjack players in here. Poker seems to be the bigger thing now. Anybody read the book Bringing Down the House? Ben Mesrich? Okay. That was an actual team, you know, of MIT guys. It was actually started in the late 70s. It was two MIT guys and one Harvard guy, and I was on that team. So whenever I would tell stories about what we would do in the casinos, I remember people were always just fascinated. I remember saying, I should write a book. Everybody just loves these stories. I should write a book. Well, sure enough, this guy came along 10 years later, was on the same team I was on, and he wrote a book, and it was a New York Times bestseller. But there's, for anybody in the investment business, there are real benefits to be gained from playing games like this and understanding them. One thing is you learn, I mean, because of bad beats or whatever, seeing crazy things happen over time, you learn to be more analytical and not too emotional about it. I mean, it's the same in investing. You can make some really good investments, and for a while, you can be dead wrong for a number of different reasons. And you learn you need to be analytical and not emotional. You learn that the math works. You learn that over time, whether you're counting cards in blackjack, whether you're understanding the odds in poker and knowing what the odds are of trying to stick around for certain, getting certain cards or whatever, how many outs you have, you learn that over time, the numbers are going to work. And a key thing that you learn is that you should never risk a lot to make a little. And that's something people still, in investing, very smart people don't get that. And the trick is, the catch is, often there are games you can play where you risk a lot to make a little, and you're going to win those games 90-95% of the time. So it just really sucks people in. The classic is selling puts or selling calls. We don't do a lot of options, and it's, you know, frankly, I'll talk about it. I believe in keeping things simple. But when you sell puts or sell calls, you're taking premium, and you also are taking the risk that something happens. And unless you hedge that risk or lay off that premium somehow, if you're just completely taking that, generally what happens, especially like picture an out of the money put on the market. The Dow's wherever it is now, 13,000, let's say. If somebody's saying, I'm going to bet on the Dow to go to 11,000 over the next month, that's probably not going to happen. It's been pretty sloppy right now here lately, but that's probably not going to happen. That's 20% in the next month, and it's already down 10 or 15% over the last several months. Okay? So which side of that would you want to be on? Well, if somebody's going to buy a put, you'd probably be inclined to say, okay, I'll sell you I'll take that premium, you pay me, and I bet it's not going to happen, and I'm just going to pocket the premium. And almost all the time, that's right. But occasionally, it's not right. And if it goes down to 10,000 from 13,000, that put may be worth 10 or 20 or 30 times the premium that I just took in, and I got to pay that. We were talking about blow-ups earlier in lunch. There's a guy named Victor Niederhofer, and that's what he does a lot. And he's a real character. I mean, he's one of these guys that he was with Soros for a while, and he's one of these guys that he seems to be always bullish. He does a lot of these kinds of things. He does a lot of betting on risking a lot. Nobody can wear shoes in his office. He turns the air conditioning down real low. He wants it really cool, and you have to whisper, you know. He spent some time in Asia, and he thinks that's the way you need to have everybody walk around in socks and be very polite to each other. And so it's really a kind of a strange working environment. But he had put together great numbers, and then 6-8 years ago, he just totally blew up. He had a couple of big bets. One was he was selling puts on the S&P, and he had some other things going in Asia. He had two big bets going on at once. It blew up, and he lost 10, 20, 30% on each of them. Next thing you know, he's down 50, 60, 70%. There was a run on the bank. Everybody won their money, and he was out of business. Well, he came back. He was gone. He was sad. He got divorced. I remember reading a story about people coming into his house and literally taking furniture out because he nearly went bankrupt. He rejuvenated himself. He was been up and running for the past couple of years. He did the same thing, and he blew up again last year. And, you know, for people that do that, we were talking about John Merriweather. John Merriweather is a famous guy. If you read Liar's Poker, he was one of the stars in Liar's Poker. Very talented guy, very bright guy, assembled a whole core of people, several of whom had won Nobel Prizes. And these guys put great numbers on the board throughout like 93, 94 through 97. And after the fact, everybody realized they were leveraging up to 50 to 1. Leverage I'll talk about a little bit. Leverage in the investment business is a drug. Leverage is something, it can be a very good drug. You can use it, a certain amount of modest leverage, and really enhance your return and enhance what you're doing, and even do it in a prudent way. Trinity, just for example, a mutual fund can only buy stocks. They're changing the rules now. Some mutual funds now, increasingly, some mutual funds are shorting. But a mutual fund typically is 96, 97, 98% long, and the other 2 or 3 or 4% is in cash. That's what they do. And it's safe. You're never going to lose any more than what you put in it. You can lose all you put in it, but you're never going to lose any more than what you put in it. A hedge fund uses leverage. Trinity, for the first 6 or 7 years of our existence, when shorting was easier, we often had 50 or 60% of our assets on the short side, and probably 120% on the long side. So if you do the math, let's say 120-50. We were 170% invested, so 1.7 times leverage. But the way we looked at it was, as long as you're not mismatching your volatility, as long as you're not, some of the shorts and the longs need to be in the same sectors, same kind of ideas, so that you're not totally, if you're buying all high-tech go-go stocks and you're shorting gold, for instance, then they can both go against you pretty easily at the same time. That's no good. But as long as you have you're keeping track of your portfolio and you have it somewhat matched, then being 120 long, 50 short, we would think, hey, we're only 70% net long, 120 minus the 50. We actually have less exposure. We're less risky than the average mutual fund. And most of the time, that's the way it plays out. I mean, again, it depends on a manager and who he is and what he's doing. But guys with leverage, I mean, Merriweather and his group, as it turns out after the fact, everybody realized they were leveraging 50 to 1. And they nearly brought down in 1998, nearly brought down the whole financial system because they lost. There was a run on the bank. They were long all this crazy stuff, Italian something bonds and, Norwegian something junk bonds and all this crazy stuff. They were short treasuries against all the stuff that they were long. We had no idea that they were doing this, thank goodness, because they're the bright guys, they're the smart guys. We had a massive long treasury bet, which is a macro thing. I'll get into that a little bit. We typically don't do a lot of macro, but we were just convinced that treasuries were a good buy. So we had I say massive, we bought a bunch of them, and then we also bought a bunch of out of the money calls. So we could only lose a certain amount on our calls, the additional exposure. But, again, thank goodness John Merriweather, JM as he was known, I didn't know he was short those. Well, he was wrong. That was one of the things that we did right without really knowing everything about it, because the Russia defaulted, Russia nearly collapsed, the whole world changed, and all their bonds, they couldn't sell their bonds. So suddenly they had to go in and cover their treasuries. They were buying treasuries like crazy. Well, he lost 96% or something over a couple-month period because of the huge leverage. Well, he's such a charismatic guy, and he had so many fans that he disappeared for a while. I mean, imagine losing 96% of your investment. That's pretty harsh. He got up and running again, And he raised more money. He doesn't have as much as he used to have. He used to have $6-7 billion, I think. Now they're running a couple of billion. Well, there was just an article a couple of days ago in Wall Street Journal. He's down 28% this year and scrambling to stop all the redemptions that they're having. Down 28% is not the end of the world, but that's a pretty big hit. And it's a bond fund, that should be less risky. So, again, I mean, my comment is if somebody loses 96%, I don't care how they explain that to you and tell you that this is what they've learned and this is why they were wrong. You should never put money with that guy again. So the fact that there's a bunch of people that are down 28% with him, good for them. I mean, maybe he'll get going a third time. It wouldn't shock me.
I want to, because there are a couple of comments or questions I would make on this poker backtrack. But the first one is on these out-of-the-money put options.
Mm-hmm.
Right? I mean, I would be interested in your reaction to this. So there are generically a fair number of hedge funds do this, right?
Yeah.
And so, but if you're an investor, maybe even a professional investor for a pension fund or something like that, if you don't understand that that's what they're doing, then, and as you pointed out, the distribution of returns is going to be small and positive, maybe big with leverage, 99% of the time, and then conceivably way less than negative 100%.
Right.
Every once in a while. But most investments that we see don't look like that. And so that if you see someone get 6 or 7 or 8 or 9 quarters or years together of positive performance, and you don't realize this is a strategy you're playing, you immediately infer that they're a genius.
Right.
And when you don't understand that there is that has shown no skill whatsoever, right. and it's just a facet of that distribution. And I mean, I don't mean maniacal, but if you were starting out a hedge fund and you were interested in not so much the purity of it, but just getting rich and getting a lot of money under management, to the extent that people don't understand that, it's a very compelling way to show great performance.
And that's one reason that sophisticated investors increasingly are demanding, not just asking, because hedge funds typically have been very secretive about what they're doing. They don't want to show their book. They don't want to expose what they're doing. So they're demanding more and more transparency, so you can go back and see how they do it. I mean, and Long-Term Capital, John Merriweather's firm, they were the classic. They were the smartest guys in the world. They had the Nobel prizes literally to Myron Scholes, they had models named after him. The Black-Scholes model, Myron Scholes was one of the principals there. So they would say, no, we're not telling you. Oh, no, trust us. It's really good. Well, if you're leveraging 50 to 1 and they were making pretty good returns, but it's not nearly what they do. I mean, goodness gracious. I mean, again, if you take past book savings rate at 2 or 3% and leverage that 50 to 1 and you're making 100%. So, it's pretty ridiculous.
The point there is that if you acquire that skill to be analytical and statistical and honest, rather than not change your opinion of yourself when you're up or down.
Right.
And
right.
Do you find that successful investors, professional investors, often are able to do that by working in a team?
Yeah, I think that helps. I think that helps. That helps. But it can definitely help, and you can, and especially when things are going against you. That's when it really helps the most. When people say, I mean, and I didn't give you the full background of my firm. Our firm, Trinity Capital, we got up and running with only $12 million, just because somebody was saying, how did you do that? And if we did that today, that would probably be everybody thinks you have to have $50 million or $100 million to start, or you can't pay your overhead. But I was naive and I thought, it's going to work. It'll work, and it did. We did well right out of the box, which was good. But we got up to, and then we closed fairly quickly because I was more concerned about performance than taking money. We got up to 2 offices, 15 people, $700 million. And then for a number of different reasons, we decided to really downsize until we got to the very extreme. By the end of 2006, my partner and I, who happens to be, it wasn't my original partner, this is my partner who's been with me for 5 or 6 years now, who happens to be one of my brother-in-laws, we gave all the money back. So we went from $700 million down to our money, which is really it's been fun. It's a pure way to do it. We don't have to worry about what investors are thinking. I don't have to write quarterly letters, and we had a big year last year, but we were very volatile. It would have made me sick to have to write some of the letters because we had some huge swings. So I just was thinking about that because we've talked each other off the ledge several times. We've been very bullish on oil, the price of oil, for a couple of years. And it's really, I was going to talk about this at some point. I'll go ahead and talk about it now. The best investment ideas, there's some guys that do really complicated esoteric strategies. And some of these work great, and these guys are really smart. And more power to them. I typically don't understand those. I like to be around things that I understand. And I think you get guys like Buffett. And one of the reasons Buffett's so smart is because he can distill things. He can take something and explain it he can not only explain it to you and me, he can explain it to our moms who don't understand finance. And she will go, oh, I get it, But everything, the best investment ideas ought to be 3 or 4 bullet points on the back of an envelope that you can just really literally say in 1 or 2 minutes and talk about. With oil, for us, it was simple. The supply of oil is not nearly what everybody thinks it is. We've had peak oil in the Mideast, and if you look at the actual numbers, they keep producing less and less oil. And that's just one point. Just a couple of points on that. It costs more and more. It used to cost 10, 15 years ago. It cost about $2 to get a barrel of oil out of the ground, and now it costs about $15. And that's not even including a lot of the other costs that are involved, like the capital expenditures that they're making for the equipment. And so it's costing a lot more. And when you look at the numbers, they're producing less. In terms of demand is greater than people think, and it seems to be very elastic. I'm sure everybody's heard here about we're all going to trade in our SUVs because the price of gas keeps going up. Well, I bet if you think real hard, you may be able to think of one person who's done that or somebody who's bought a hybrid. But for the most part, it's not happening. Everybody's driving. And now we have China and India coming on. And I've been in the investment business about 20 years now. And people have been talking to me, when I got in the investment business, people were saying, oh, imagine Gillette, if they just sell, a razor to 1% of the Chinese out there. Look what that is to their numbers. Look what that's going to do to their earnings. Well, it's a fun little model. It's a fun little game to play. The problem is no Chinese were buying any razors. They didn't care. They're all out in the fields. Well, we've gotten to the point where, guess what? A lot of Chinese are buying razors. They're buying cars. They're buying jewelry. Indians, Asians in general, we've gone past the tipping point, and that's real. We have 300 million people in our country. There's 1.3 billion people in China, about 500 million of whom live in urban areas. Well, they have 100 million cars in China right now, and they have twice as many people as we do, nearly, if you count the people that are really car buyers and are probably, So they have roughly twice as many people, half as many cars. Where's that going to go? They're going to buy cars, I can tell you, over the next few years. I'll give you a quick India. Our whole family went to India last fall, and we hooked up with, actually it was neat, it was one of Taylor's classmates' parents that we hooked up with. We had a really fun time with. He's an Indian businessman, grows tea. His tea is, he's got 12, 13 tea farms. His tea is the highest selling, the highest priced tea in Harrods in London. So it sounds like it's, real tea. People really like the stuff. But he said, the way he explained it was, look, there's 1.1 billion people in India. And he says, at this point, probably 100 million or so are equivalent of the U.S., what we think of as, us as consumers. So only 10%, less than 10% of their population. He said over the next 3 to 5 years, maybe 3 years, no more than 5, that 100 million in India who are like us is going to grow to 250 to 300 million. So they still will sort of be catching us in terms of the people they have that are like us. But when you think of what that does to an economy, you talk about, 3 or 4% GDP growth is big. for an economy where you're going to go from 100 million to 250 to 300 million, that tells you, I mean, we'll talk about international here in a little bit, but I can tell you, if I were young and either didn't have a family or had a family who was willing to do crazy things, and I wanted to do something adventurous and I wanted to make a lot of money, they're just unbelievable. I would go learn a language and go to India or China or maybe Brazil. Brazil could be this. It's very similar there. There's going to be huge opportunities, and there's mismatches, there's inequities, there's what's the term I'm looking for? There's inefficiencies. There's so many inefficiencies there that don't exist here anymore because there's so many smart people in the investment business and in the investment banking business and in the consulting business and in whatever business you want. Over there's so much opportunity, there's going to be so much growth that there's just going to be a lot of ways you can go figure out how to make, how to be very successful. So getting off on a tangent a little bit, but back to leverage. Which ties into fatal flaws. Some people, if you can't have too much of a good thing, when they start doing something sounds really good, let's do it a little more. And again, a certain amount of leverage can really help you, but it's a real danger. I'll tell you a good story. Another thing you should do. Good books. You guys have, a number of people had read When Genius Failed, it sounds like. When Genius Failed is Roger Lowenstein's book on John Merriweather and the whole long-term capital collapse. There's a lot of books on Buffett. Lowenstein is a great author, and he wrote one of the best on Buffett, which is Buffett. I think it's The Making of an American Capitalist. And another thing you should do is you ought to go to an annual meeting in Omaha. I've done that 6-7 times every so often, and every time I go I learn something. But Buffett just answers questions for 5-6 hours, and it's just, you're going to learn something. You're going to learn something. I guarantee it's going to be worth the price of your ticket. And if you're creative, you can figure out how to do it. The other thing while we're on Buffett is go on his website. You ought to read his annuals. If you're serious about the investment business, you ought to read his annuals, particularly the ones in the 80s where he wrote the 80s annual reports, which he'll send to you free or for postage or something. Or he wrote about a lot of great concepts. I mean, I think he's sort of written about them enough. He doesn't keep repeating himself, but those were really good. But I was in an annual meeting and somebody asked about leverage, and Buffett says, if you're really successful and you're really wealthy, the only thing that can really blow you up is leverage. The only thing. So here's just some advice for you, and you probably know this, but I can tell you a lot of people that didn't do this. If you make $100 million, if you make $500 million, that's great. Take a certain amount of that, 5 million, 10 million, 15 million, whatever it is, so you can live like a king or a queen the rest of your life, and put it somewhere safe. And then go play with the rest of it. But I can tell you, I could give you a half dozen stories, and I'll just tell you one. This was a guy who was my age at the time, and I had a bunch of friends who knew him. I didn't know him, but I'm not going to say his name, but I had a bunch of friends who knew him and knew him pretty well. And he was at Long-Term Capital. So this was, it was 98 when they blew up, so we were each late 30s. And he'd made about $300 million. Pretty good day's work by the time you're late 30s. Well, $300 million was nice, but you know what he really wanted, of course? To be a billionaire. So he had his $300 million. He didn't have $10, $15 million set aside. He had his $300 million, every penny of it, in his fund. Well, that's pretty good, but he believed, he definitely believed that in there, all those, the numbers that Dr. Brown was talking about, which you need to get at and get behind. I mean, if somebody had gotten behind him and said, hey, you're at 50-to-1 leverage, this may not be real. He didn't think that. He thought, we're going to make at least 15, 20%, if not 30 or 40%. So he had his $300 million, every penny of it, in his fund, and then he went to the bank and borrowed as much as he could and put that in the fund. So there's leverage. He went from $300 million to nearly going bankrupt. He lost everything. He nearly went bankrupt. And I mean, it's not funny, ha-ha. It's funny, sad to have somebody. So again, some of you in here will make $100 million. First, give $50 million to the University of Florida. Do that first. And then take 10 or 15 million for yourself and put it away. And then play with the rest. You can do crazy things with the rest. But I could tell you other stories about that. But that's a fatal flaw is leverage. Another one is hubris. Being arrogant. As soon as you think, We make mistakes all the time, every day in our business, and that's not false humility. We do. Now, if you try not to lose money, most of the most serious mistakes we make are errors of omission and not errors of commission. They're errors where we should have done something and we didn't. And we pretty much knew, but we just didn't pull the trigger on it. And we had a chance to make a lot of money and we didn't. But you know what? We didn't lose money. So those are, if you want those to be your biggest errors. We also do make errors. We lose money on things. We do make errors all the time. It's when people in this business really think they're on top of it and they're smarter than, they had a good run. You're about to get your legs chopped out from under you. It just happens all the time. I've seen it. So another fatal flaw that I see a lot is, and this also ties into ego a little bit, is the Nih syndrome, I call it. That's the not invented here syndrome. And a lot of people feel like unless something was their idea, or maybe they had an idea and really, they got it from somebody else, but they really ran with it and worked it and added to it and sort of made it their idea, then they could bet big and invest. But there are a lot of people, if they didn't come up with it, they don't want to hear it. They don't want to hear it. If it's their idea, they can invest in it. One of my friends said about me one time, he said, he talked about my firm. He said, you guys are you're the best at taking somebody else's idea and then making more money out of it than they do, which I thought was a compliment. There really are not a whole lot of, and you can't have a big ego if you're going to do that. There really are not a whole lot of original ideas out there. So recognizing a great idea is as important, often more important, than really coming up with a great idea. Because it's recognizing that idea and running with it. That's really what counts. Another fatal flaw is, and I see this, somebody in the lunch asked about my favorite analyst, Wall Street analysts who we like. I realized early on these guys are typically all smart. You read their reports and they're all, they sound great. A lot of times they're just wrong. One thing that a lot of analysts tend to do, which is a fatal flaw, they know so much about everything in a company, which is good. It's nice to know a lot about a company. But they really don't, they lose track of the minor issues versus the major issues and what's important. You figure out what's important about a story and focus on that. I think I talk about price. I've got something about pricing pressure at some point, but that's one of the things I learned. The shop I was at Water Street, and I talk about the advantages of short selling later, but one of the great advantages of selling stocks short is when you're betting on stocks to go down. You're trying to find a model that doesn't work, find a reason that their earnings are going to disappoint. And one of the great things about thinking that way is it makes you a better long investor. Because when you come at something cynically and you're trying to find out what's wrong with it, sometimes, some of the best things I've done on the short side, and too often I didn't take advantage of them on the long side, but some of the best things I've done on the short side, I said, this is not a short. This is our story, and I've made all these calls, I've checked with these people, this does not play out, this is not short. I can tell you a lot of times where I should have just bought that thing. Does anybody remember Clearly Canadian? Clearly Canadian, that's been a while. This will sound arrogant, but there was a time where I knew more about Clearly Canadian than anybody in the world. I spent 6 months of my life with spending probably two-thirds of my time talking to distributors, talking to anybody who was in the channel, figuring out what the margins were. And early on, my boss said, and because we love shorting fads, the stock was like $8 or $10, and he said early on, this is a short. We should short this right now. And I pretty quickly said, this is not a short. Not yet, not yet. And it was funny how many people said this stock was going to go to $30, and then they were selling. Well, it's hard to do that. But this stock went to like $28, $29. So we could have had a triple out of it. I knew it was going up. We were just, my boss, who was always wanting to short things, just kept looking around saying, tell me when it's a short, tell me when it's a short. We did the same thing with, if you remember the Nordic track, the ski thing. He had me look at that 3 or 4 times, and I kept saying, it's not a short, not a short, not a short, because it wasn't easy it wasn't hard to get the channel, make the calls in the channels and find out they're selling, people love it. But it was a short. Those are the kind of things, though, when those come unglued, they really crack. I mean, there's a Nautilus chart. We'll get to a Nautilus chart. I wonder if I can just see how easy this thing is. Nautilus is Bowflex. You've seen those infomercials. Same sort of thing. And it was the same. We kept looking and looking short these. It's funny how many of these stocks get to about 30, but then once you find out that, and a comment I was going to make was what's important, minor issue versus major issue. Often a major issue in something is pricing. If somebody has pricing power, that is so key. That is so important when you can raise prices. I can remember I had buddies trying to short Starbucks on its way to after it had gone up 3 or 4 times, and it was going to go up 3 or 4 more times, and people kept trying to short it. And at one point, the short story was, the comps, the only way they're hitting their comps right now is by increasing prices 2 to 3%. They keep increasing prices 2 to 3% in order to keep their comp number up. Well, yeah, that's great, but except that's really a bullish thing. When you can increase prices 2 to 3%, and everybody keeps buying Starbucks coffee, and they keep opening stores, everywhere you turn around, 3 on a block some places, it's bullish. Ultimately, that stock ran out of gas, and it's been a great short for the last year or two. But for 4 or 5 years, that was it was and again that's the power of having pricing. Kenny G, I'll just tell you a quick story. Kenny G is a guy we happen to hang out with sometimes where we vacation. He just has ended up going to this place. He's kind of an interesting guy. But Kenny G made way more. Where he made most of his money is because when Starbucks was getting going, and Kenny was from Seattle, where Starbucks started, and Howard Schultz, the CEO, was. How he was, fits in when you think the sax playing, it fits in with the cool, the sort of their image. He would have Kenny G come play the sax at grand openings, and he started having him do that around the country when they were in the early going. Well, Kenny, to his credit, said, "Don't pay me, just give me options." So Kenny took options for a number of years every time he would show up, and the options cost nothing. They cost him next to nothing, and the stock was in the early going. Well, he made more. Kenny said, I think at one point, he made more out of his Starbucks stock options than he made out of all the concerts forever for the longest period. Okay, I'm really rambling now, but the pricing is the point here. And when Nautilus turned and they no longer had pricing pressure, and they were having to spend way more for advertising, you could track it in their cost of goods sales. And it was funny because the analyst who was bullish on this for a lot of years. This stock was a great stock for a number of years. The analyst who was bullish on Nordic Track for a lot of years, he kept saying, no, it's not over till until you see that cost of goods sales, so that the amount they had to pay either their salespeople or the amount they had to advertise, the amount they had to spend on the infomercials, until you see that percentage go up, it's not over. Well, the funny thing was, he was dead right. And for a year or two, that percentage never went up. It finally started going up. And I remember calling him back, and my boss saying, call him up, see what he's saying. It's over, it's over. Well, it was over, and the stock went from 25, 30 to, went away, went to 0. But when I called him up, it's this guy in Boston, and what you see a lot is complete denial. Then he starts making excuses for why, no, it's okay, it's okay. So it was like it had been such a great stock for him for so many years, he couldn't turn it loose. So the very thing he pointed to, a year or two before as being, this will be the Achilles heel. When this happens, it's over. He was right, but by the time it happened, he couldn't. He didn't admit it. Okay, fatal flaws of pricing. Just one more. We're seeing this with oil. I mentioned with oil. We're seeing it now with oil. The price of oil has gone. And by the way, inflation adjusted, a barrel of oil, which is now $106, $107, inflation adjusted in 1980 was about $100. So you inflation adjust oil and it's done nothing for everybody who says, no, it's really screamed. And I think I'm still bullish on oil because it's not changed our habits. I mean, people have not cut back yet. And the supply-demand, there's an imbalance there. Other things will come on. all the other alternative energy, solar, all that sort of thing. But they're expensive, and it's hard to get that in a hurry, and it costs a lot of money. One other example of pricing, and this has been a long time, but this was a classic. Buffett made billions of dollars buying Coca-Cola, and there was something that happened. I can't remember what year it was, but there was something that happened where there was a strike or something, and the price of sugar there was a sugar shortage, and it went up. You remember this? It went up meaningfully. So much so that they had to the only thing they could do, it was such an important ingredient, such cost of good, they had to raise the price of Coca-Cola meaningfully to account it, and they just knew that was going to crush sales. Sales kept growing. Sales just kept growing. So smart guys like Buffett looked at that and said, aha, pricing power. And sure enough, Coke had, over the years, Coke was for a 10, 15-year period was one of the best stocks on the New York Stock Exchange because they kept growing. They had huge growth, and they had a lot of pricing power. Okay. Investment personality. What I want to get at there is just another fun thing about this business is you'll notice, and not always, but a lot of times people's personality reflects the way they invest. You'll have people who are very patient, hardworking, very steady, maybe a little cynical. They'll be value investors. They want to tear apart the balance sheet. They want to be sure they know everything's there. You have people who are very cynical. They're short sellers. You have people, guys with ADD, the guys that can't focus on any one thing at any given time. Often they're traders. I've got a great friend that he's very good. He was the last year of the NASDAQ bubble. He's doing 1 million things at once, but he knew how to really press things. He was up 200% in a big hedge fund. But he's a guy that I'd be on the phone with him. Somebody asked earlier where you get your ideas. We read a lot, we get ideas, we talk to people, but it's your own network is where you get a lot of ideas. And when you're out doing research, by the way, and you're talking to suppliers and distributors, and you're really making phone calls, when you're really doing digging, some of the best ideas come from those people. And it's funny how people will talk to you. And often they'll either talk to you because they're nice or because you have information you can trade with them. People love to trade information. But one of the best questions that I used to ask or still ask when I'm talking to people is, in a business, who are your best competitors? Who do you really respect? And they'll tell you. And often they'll say, oh, such and such, they are so good. Here's why. They're so well managed, and they have this down, and they're crushing us here, they're crushing us there. And it's like, I can't tell you how many times I've thought, geez, we're thinking we're supposed to buy this stock. And here's this guy telling me why their competitor is so much of a better company and all the good things that are happening there. Growth versus value. I'll just go through, just try to hit some highlights of things that are important on here, I think. Some people you can put in a box and they want, when you're a growth stock investor, value guys care more about a balance sheet. They may or may not want a catalyst. They don't care if they know of something good that's going to happen. They just know that they're getting assets cheap, maybe getting a management team cheap, and that at some point something good's going to happen. Growth guys typically don't care a lot about a balance sheet. They want earnings, and those earnings need to come through. A lot of short sellers like to short growth stocks because they're so expensive. I can tell you, one of my rules of short selling is don't short on overvaluation alone. I don't care how expensive a stock is. If it's overvalued, if it looks like it's expensive, often there's a reason, and often it gets more expensive. Or they just keep coming through with earnings surprises. So whatever you were using as their earnings number, you've got to keep raising it. And it's just, I remember there were some companies where you just, when you're short a company, they're getting ready to announce their earnings, and you just get a pit in your stomach. It's like, oh, they're going to kill me. You just know it. They keep doing it. Every quarter is good. They're going to kill me. And more often, at least for me, more often than not, that's right. That pit in my stomach is right. Whereas other companies, it's like, show me what you got. I can't wait to hear this conference call. I can't wait to see these earnings. We're hard to put in if you ask, we're hard to put in a box. We do some growth, we do some value. I think one of the most exciting kinds of stocks to buy are stocks that are perceived to be value stocks, and they're priced as value stocks, but they're really growth stocks. Bill Miller is a guy with Legg Mason you may have heard of. He's having a tough go of it lately here. But Bill Miller had a great run where he beat the S&P 13 or 14 years in a row. And he did it, half of those years was the strength of a couple of investments. It was Dell and AOL. And Dell was a classic stock that he bought when it was selling 8 or 10 times because everybody said it's a box maker. It's an assembler. They have no intellectual property. They have no patents. All they do is put things together. And it really was a mail order company, basically. You know, you calling over the phone. So it shouldn't deserve a multiple higher than 8 or 10 times, which is historically what those kind of companies got. Well, all that was true, except they were really good at what they did. They were the best box maker. They were the best assembler. They were in the middle of a PC boom that was growing like crazy. And they, for 5, 6, 7 years, they were showing earnings growth of 20 to 40% a year. So it was a growth company, even though when Bill Miller and guys like him started buying it, it was 8 or 10 times. What you get out of that, you do the math, and if you just buy a company, whatever multiple you buy a stock at, if you're using an earnings multiple, and this is just easy math, whatever those earnings grow by, that's what the stock will grow by if the multiple stays the same. You buy something at 12 times, if they grow earnings 12%, it's still going to be a 12 times multiple. The stock will have gone up 12%. Well, the real kicker, where you really do well on the long side, is when you get growth. You get growth, so you can get 20% or more growth, and you get multiple expansion. So that Dell, which was selling at 8 or 10 times, ended up selling at, I think, got as high as maybe 30 times. It was a 10 or 15 bagger over a 6 or 8 year period. It ran out of gas, as often as a lot of these growth stocks do. But until then, it was a huge thing. We think we have some of those in our portfolio right now, and they're the oil service stocks, or people that called arms merchants. I mean, when the internet was going great, Cisco was an arms merchant, and suppliers to Cisco were arms merchants. If they were the guys supplying the arms to everything that was really powering the internet. And you always want to look for arms merchants and toll booths. Anywhere you have to go to pay the toll to go through, because that's good business. Well, some of these guys that are like the offshore riggers, offshore rigs right now, things like Transocean and Diamond Offshore. These things are selling at 8, 9, 10 times earnings, and they're going to grow, we think, 20% or more. This year, they're going to grow at 30% this year. The reason they're selling there is because people don't believe that growth. They say it's going to, demand's going to slow, it's going to grow, earnings are going to go like that, and the growth's not going to be there. So they should be they should be 8 or 10 or 12 times earnings. But we'll see. We think that's not the case, and that they've been growing at huge rates, and the stocks have been great stocks for the last year or two, and we think that's going to keep happening. Active versus passive. I think there's a little bit of more of a trend nowadays in the hedge fund world to being active. If people think they can impact management strategy, and there's several guys I think of that are doing that. There's a guy in London who's had a couple big years in a row named Chris Hahn at the Children's Fund. He's an interesting guy and a very smart guy. He's big on cash flow, free cash flow. But he's a mild-mannered guy, but he just loves to get in there and rattle the cages. I mean, he bought Deutsche Börse, which is the exchange in Germany. It's like our New York Stock Exchange, and really threw his weight around. He became the biggest shareholder. Teamed up with some other guys, and they helped sort of not let the CEO do something he wanted to do because he was going to spend money foolishly, and it ultimately ended up helping get the guy ousted. He's tried to do the same thing with a company in Japan we owned for a while. We were tagging along with him, and they couldn't get it done. J-Power, a utility in Japan, they want him to raise the dividend. He's also one of the biggest shareholders in CSX, which is has a big presence in Jacksonville, and he wants them to pay a dividend and do all these other things. So sometimes it works, sometimes it doesn't. investing versus trading. One of the great things about long-term investing, and when I say long-term, our longs that we own for long-term, some of them we think we're going to own for a long time. It seems like the ones that work well, that we do own for a long time, it ends up being 2 to 3 years. So it's not 5 or 10 years, but it's 2 or 3, and generally if it's worked well, we've made good money out of it. You get long-term tax treatment, which is just a huge advantage. You know, when you pay 15% on your gains, and you know, McCain has, I think, has more of a chance than he did a month ago because the Democrats are beating up on each other. But I think the odds are pretty good that I don't know who all this crowd's for, but I based on my college kids, I could guess. But I think Hillary's pretty much out of it. Obama's going to win, and he's probably going to beat McCain. So, and he's a very likable guy. I think he's probably not. He wants to tax everything I make, I think, before it's all said and done. He's going to raise the taxes, but you know, maybe we like doing it because he's such a likable guy. But so that's going to change. That's a long story to say that it's going to change. I think the long-term capital, the Democrats are going to win, and the tax rates are going to be changed. But right now it's 15% long-term and 35% for short-term. Huge difference. Huge difference. So you're much better off if you can own your longs for at least a year. Some people just don't have the personality. And some people just, you know, are just natural traders. My theory on traders, by the way, is there really are not many great traders in the world. People who can sort of day trade or pick things up. There are some. I know some. There are some, and they're good. But we're lousy at it. You know, I can just tell you in terms of things that we do to trade, we're wrong 4 out of 5 times. We still try. You know, don't ask me why, but we still try here and there. We know not to spend a lot of money on those kinds of things, but. Just something I'll tell you. I talked a little earlier about your gut and things that you feel. Some of the best, my best investments, my best trades, are because I did something and I either had buyer's remorse or seller's remorse. You know, I did something and right away it felt wrong. I'm sure you've done that. You know, you guys have all, and it doesn't have to be investing. It could be anything. I was trying to think of a good example, and I thought of one. You know, where it's just tearing you up. You know, the extremist is just something that's tearing you up. I thought of one. One of my sisters went to Alabama for a year to transfer, but she went to Alabama. She actually got a master's degree from here, but she went to Alabama for a year, and the sororities was a big deal, as it still is there now. You know, I think it's somewhat of a big deal here, but not like it is at the really southern schools like Alabama. And she had 2 ones she was picking for, back and forth, back and forth. She finally decided, and she had to drop something in a box, I think, drop something in a box and leave. And she was walking across campus, and she nearly died. She just said, she was just, her whole body was just racked with, you know, that's wrong, that's it. And she went back and talked them out of it, which apparently you can't do. You know, apparently you drop it in that box, and it's, you know, you sign your life away. And she just was so adamant that she said, no, it's the wrong one. It was... I forget what it was. I forget the box she took it out of, but she went over and became a Chi-O. So that was for her. That was or was it? No, it wasn't. No, it wasn't. Was it? Yeah, okay. But anyway, you know what I mean. You've all had something happen like that. For me, that's often the best indicator. And often it's something that I've sold, and it may have been something I made some money on. I thought it's just time to sell it. And I sell it, and I just feel like, what did I do that for? And I'll buy it back. Don't be afraid to just buy something back or sell it. Just reverse what you're doing, because it's if you're, you know, you've got your instincts often are the best things along those lines. Bottoms up versus thematic. We tend to be bottoms up investors. We're not big theme investors. We want to know individual companies. We want to research them. We want to know, you know, we want to know people. Management is just a huge thing for us. I can tell you that when you're invested in good people, good things happen. And when you're periodically what we like to do is we'll look at our top 10 longs and we'll say, all right, let's just grade the management team. That's all we're going to do. And by the way, sometimes we know them pretty well. If it's small cap, mid cap, maybe we visited them, maybe we've hung out with them a little bit, we've been at a conference where we've seen them, we've heard them, we've been on conference calls. Sometimes we don't know them any better than you know, I don't know them any better than you just from reading the paper. But still, you get a sense for them. Even if it's a big company, you can get a pretty good sense. And we'll just go through and grade them. A, B, C, you know, B+, A-, C+, whatever. And I can't tell you how many times the ones that we have, you know, B- or below, it ends up being a lousy stock. I mean, we had a stock that nearly went to zero, and we loved the concept. It was one of these story stocks. But when we graded the management team, we had to admit, it was like, they're kind of flaky. They really don't, they don't really inspire confidence. Well, sure enough, the stock blew up on. We were selling all the way down, so we didn't get scorched. But we had to go back and go, gosh, we got B plus or better for 9 of our 10 management teams, and the one that really hurt us was the C plus. But themes, some themes can work well. Some themes lately, we've also played a little bit on a theme that's been a good one is the agricultural theme. I have a chart of potash, which I'll go back to, but Monsanto, these sorts of things. I mean, the world is eating more food, and anybody who doesn't think we have inflation is not looking at food and energy, which is a pretty, I mean, it's a total racket. What our country does with CPI is just it's total nonsense because they back out food. Let's see how many people have to eat. Okay, yeah, they back out energy. How many people need to heat their house, need to drive their car. So those are the areas where there's huge inflation. So we have huge demand in the Chinas and the Indias of the world, and we've got big demand for fertilizer, and these stocks have just been rocking. I mean, somebody's soundbite on Monsanto. Monsanto does the seeds, and they do the various things that are where they chemically engineer them, and they produce bigger and better plants and all that sort of thing. Well, as somebody said, which was a great soundbite, it's good if you can get, I talked about bullet points earlier, it's good if you can get nice soundbites too. And somebody said, a couple of years ago, this person said, look, Monsanto, they are the Microsoft of that world, of the agriculture world. And that was now, Microsoft has actually been losing their luster a little bit. I think it's been more, Google and RIM and Apple lately, but you get the point of that. All right, macro investing can be very fun, can be very profitable, just like any types of investing. Sort of the comment I would make about macro is that attracts people. If you're interested in currencies, you're interested in interest rates, sort of a view of the world. A lot of people, these people tend to be more thematic. We do a little of that. We don't do a lot. Sometimes we're not that great at it. Sometimes we have been, like the Treasury position I mentioned in '98. But for the most part, we're not that great at it. But it's important to have a view of the world. And people that are interested in macro tend to be people that are interested in politics. They're also so interested in lots of countries and what's happened. There may be people that speak another language and are really, more interested in reading The Economist or the Financial Times, as interested in reading that as they are the Wall Street Journal, let's say. International, I've talked about international a little. Again, I made my pitch. What I would do what I would certainly consider if I were young and hungry. It's just a lot going to happen. I hate to say this, and I don't know that this is going to be the case. I'm a red-blooded, huge American, big patriot, but we probably during your lifetime, during my lifetime, definitely during yours, I think we are very likely to not be to lose our status as the superpower, at least economically, because the numbers are you just can't fight the numbers. India and China, the size they are and what they're growing. And they want to be like us. That's another thing with oil, by the way. The Mideast, China, all these companies that produce oil, they're keeping more and more of it because they're raising their standard of living. As these economies do better, they want to live like we live. It's just natural. They want to drive cars. They want to air condition their homes. I read an article that was just talking about in the Mideast when people leave and they leave their thermostats on 68 degrees and they're gone for weeks. What do they care? Oil costs them nothing. Well, that means we don't get it. There's not as much leaving the country as it used to. So it's all part of the same issue. Sector-specific stocks, funds, you've seen those. I don't have a lot to say about that. Those can be interesting. Again, another thing about the investment business that's fun is I would hate to be like in the mortgage business right now. What a disaster. What are you going to do? You're just worried about keeping your job. I'm just using that as an example because that's an industry that's on its butt at the moment. Any given time, there's industries that are sort of down and out where you have great runs and then they're down and out. The great thing about the investment business, and this is true of investment banking too, you sort of go where the action is, go where the money is. But in the investment business, the world is your oyster. You can invest in whatever's go whatever's hot. If a certain sector is out of gas, Starbucks is peaked, you sell it, you move on, you go somewhere else. So I don't sector specific. And I'll talk in a little bit about just sort of random ideas I had about getting jobs, furthering your career, that sort of thing. I mean, if you end up with a sector-specific fund, that can be great. You can learn a lot, but it's not, unless it's just really a sector that you love. I don't know if it's the end-all and be-all where you want to spend your whole career. All right, short selling, I'll talk about that a little bit. I got into that. I think I said I already said it can make you a better investor overall, can make you better on the long side to really understand the short side. The leverage is good, and it makes your portfolio less risky. Me personally, we don't do a lot of short selling now because it's harder. There's too many people doing it, and I'll jump to the bottom there. The odds are stacked against it. There's, you have to borrow the stock. One, you have to be able to borrow the stock. And when I got going in the early 90s and then started my fund in the mid-late 90s, that was never an issue. And if you ever saw the short interest get to be up to, say, 10% of the float, the total float of the stock, how many shares were outstanding that actually trade that aren't closely held, it was a little bit of a red flag, and you worried a little bit because it could be tough to borrow. That costs more to borrow it. They suddenly start charging you. But it didn't happen that often. Now, I can't tell you how many times 20 or 30% of the float is short. And you just look at it on your Bloomberg and you do a DES and look at the description and you punch up and you look at the float and the short interest and you go, because it's dangerous. You get in short squeezes. You can get bought in. The stock's running up and your prime broker, wherever you have that stock borrowed, will buy you. You have no choice, and you can fight them, but they're gonna buy you. Taxes, of course. I'll tell you a good short squeeze story in a second, but taxes. We have lots of shorts on our books from 95, 96, 97, 98. We have a lot of shorts where we have a big gain that we have never booked it because as soon as we cover that short, it's a short-term gain, taxed at 35%. That's just the way it is. It doesn't matter how long you're short, it's always a short-term gain. So the hurdle is that much higher in order for a short to be good. Also, I talked about interest rates. In the early, late 90s, interest rates were higher. You got a short rebate. So often you could make 10 or 15% from your short book, that portion where you were short, even if the stocks did nothing. They just stayed right there where they were because they were paying you a rebate. While as interest rates have come down, those rates have gone down. So the rebates have gone down. And a lot of the shorts where the short interest is high, the brokers now charge you to borrow it. So you got to pay a certain percent depending on the short, which just makes it a lot harder.
Why do you suppose there's so many more shorts now? Is it more sophisticated advantage of that, or is people just bearish?
It's just so much hedge fund money. Just there's so much money. I mean, when I started in '95, I meant to look this up, and I couldn't. I don't have these numbers exactly. But when I started with Water Street in '89, '90, I worked there the summer between business schools. So in '89 when I started, I remember when Tiger was $400 or $500 million. And I remember we just thought that was all the money in the world. And we would do the math and say, good gracious, if you make 1% to 2% management fee and then you make 20% of the profits, and we'd do the math and just think, that's obscene. Well, now, within how many years later, my fund was bigger than that, and it just didn't seem like a big deal because there are all these billion-dollar funds. Now I just read about a Farallon. I know. I'm good friends with the guy that runs Farallon. I went to college with his wife, and he's a very smart guy, and they've done great. They're running $36 billion. There's so many. I mean, there's so many $5-10 billion hedge funds right now. Well, what happens is the amount of stock they have to borrow to just get nominal short positions on has gone up so dramatically. I think we've gone from $100-200 billion in hedge funds when I started to over $1 trillion. So it's just math. It's just math. There's just so many more people that short that it just makes it hard. Short squeezes are scary because and inevitably there's going to be some not so sophisticated money that are short. As soon as shorts start working, then everybody wants to short. And then you have some good news in a company and the stock's going to go up. And it's going to go up a lot. And these stocks can really run. When you're in a short squeeze, oh, that's one of the risks of, obviously a big disadvantage of selling short. It's unlimited risk. You have no protection on how much you're going to lose. And we've been pretty good on the short side for a lot of years, but I can tell you we've been in shorts that have gone up 3 or 4 times. Where it's a small position, because maybe it's worked and it's gone down to $3 or $4, but you think it's a 0, so you don't cover it. And the next thing you know, it's 8, and you're thinking, I'm not covering it here. And then it's 12, and then it's 18. So I can tell you, I can point to a number 3 or 4 times against us. The math on the long side is pretty easy. You can't lose any more than you put into that stock. If it goes to 0, you lose all you put into it. If it gets cut in half, you lose half of what you put into it. The other more that's less noticeable, but unless you're managing a portfolio, I guess it's sort of the more insidious risk here is if you have a problem on the long side, as it goes down, it becomes less of a problem because it gets to be a smaller and smaller position. You got a problem on the short side, and it becomes a bigger and bigger problem. It's thought of a not funny story, but a story that my kids will remember. It was June of 2000, and we were up 10 or 12% for the year. We were having a pretty good year, halfway, and we're up 10 or 12%. We had a monster short position in a company called Conseco, and it was an insurance company that we knew well. I'm not going to say we knew this better than anybody in the country, but we were in the top 10. I mean, we knew this thing well. We had consultants that had worked on it for us. We knew it every way from sun. I mean, the consultant. One of my favorite lines from this one was one of our consultants that we really trusted a lot. We said, are you sure this? Oh, they were potentially going to hire this guy, Gary Wendt from GE Capital. And we said, can Gary Wendt save Conseco? And this guy's comment was, even God couldn't save Conseco. It was a 0. It was a 6 or 7. It was a $5 stock. We were convinced it was going to 0. We got on a train to go to New York. And then we rented a car. I'm with Virginia and all 4 of our kids. We're on a train going from Jacksonville to New York, and then we were renting a car and going to Vermont for something in June, summertime. And we had somebody that we were convinced was really close to this guy, because the rumor was that they were going to hire Gary Wendt, who was a GE, he'd been a hero at GE Capital. And the stock was going to go up if they hired him. We had a guy that was good friends with Gary Wendt's closest friend. Said, I just talked to him. The deal's on the table. He's not going. He's not doing it. We were like, wow, okay, that's the only thing we worried about. We know all the fundamentals here. And so we even increased our, we were stock. I'm on a train. My cell phone is in and out, and they hire Gary Wendt to be CEO. They basically paid him $100 million to come run the company. And what we found out later was Gary Wendt had told his buddy, oh, yeah, I'm not going to do it. But at the last second, after telling his buddy, he was like, it's too good to pass up. I'll do it. Well, good for him, great for us. We lost. This stock started running, and I just kept covering and covering. Fortunately, I kept coming because, if it goes from 5 to 10, and let's say it's a 10% position. It was bigger. But let's say it's a 10% position. If it goes from 5 to 10, it's suddenly a 20% position, and I'm betting the firm. I'm literally betting the firm at that point. And I just said, I always told people when you hire a hedge fund manager, you're hiring a risk manager. That's what you want, and you just couldn't do that. So as much as I hated to cover, I just had to keep covering, and I was just miserable. I remember this restaurant we went to. The kids may remember that. We went to some restaurant in New York, and people were talking to me, and I'm like, well, I don't even hear them. And the stock kept going up and up, and I'm covering 100,000, cover 200,000, cover 300,000. I'm covering 500,000 at a time. We were short, 6, 7 million shares of this stock. And the thing was, the longs are just buying it. I can tell you who they were. I knew some of them. One of them was at Fidelity. And they don't know they know it's probably a lousy company, but at this point, the squeeze is on, baby. Stock is going up. So I'm trying to sell 500,000 shares, and the joker at Fidelity is trying to buy 5 million shares, and it just keeps going. We were up 10 or 12% when we started that train trip. It took me 6 months to make that 10 or 12%. We were dead even by the time the train got to its destination, and I could hardly focus. It's about the only time in Trinity's 12-year history that I actually called my 3 or 4 biggest investors from my hotel room and just said, I just want you to know we got a problem. We're okay now. I've taken this down, but I just want you to know because they get monthly results, and that May good number that they had for May, it disappeared. Just so you know, we ended up 25% for the year, so we made it back. It ended up being a good year, but that was brutal. One more short squeeze story, because these are it's when you're this one's even more fun because I wasn't in it. It was a lot more, but this is harsh. I mean, this is not right, but this is the way the world is. Wall Street's a tough place. I mean, you all probably know that. Anybody that's interested, Wall Street is it's dog eat dog. It's every man for himself. Throughout the 80s and early 90s, there were 3 hedge funds, probably 3 or 4 hedge funds that were sort of the biggest and the brightest and the most well known. One was Tiger, Julian Robertson, who's a great guy, neat guy. One was Soros, and I'm not going to tell you the other one. If you follow you might be able to figure it out. But the story's on them, so I'm not going to name them. This one had money. There were a group called the Feshbach Brothers. And the Feshbach Brothers, if you go back and read, they were interesting guys. We knew those guys. And there were 3 brothers, and they were real characters. They were really flamboyant, and they loved talking about their shorts. And I remember an article in USA Today where they named all their shorts, which was like suicide. Put a target on my chest. And so everybody could. But they had been doing great. They were flying high. They were cocky. This large hedge fund had a huge pot of money with these guys. So they were running, I'm not sure what they were, I think they were running $500 million or so. And 150 million of it came from this one large hedge fund. You probably can see where the story's going. We got into where the market turned. The market had been really negative for a while, and everybody was making money on the shorts, and these guys were gloating. Well, when the market turns on short, it does it with a vengeance. When there's a short covering rally, when you hear the term short covering rally, let me tell you, if you're short, it ain't fun. They go up, these stocks, the market may go up. Just the other day, the market, we're not very short, but the market was up 4% a week or so ago, if you remember that day. We had a lot of shorts up 10 to 20%. When you do that across the board, that you lose a lot of money. We had my brother, he runs a hedge fund in New York. My brother had one up 100%. There were some other ones up 40 or 50%. The math is just crazy. Anyway, this very savvy, ruthless, very successful hedge fund guy saw what was going on, and the terms of his deal with the Feshbachs were he could pull his money out. Instead of having 3-month or 6-month redemption rights, he had it sort of on either a monthly or every 2 weeks. I mean, because he was such a big guy, he had the right to take his money. So picture this. He knows they're shorts. He sees them starting to run. He sees what's happening with the environment. This guy, by the way, is running lots of billions, probably running 5 or 10 billion. He's in there buying these stocks, and he's telling these guys he wants all his money. So they've got to squeeze themselves in order to give him the money. They've got 20, 30% of their portfolio with him. So they're buying, he's buying, others are buying. It's the hyena strategy, this theory, the hyena goes and gets the weakest animal in the herd. Well, these guys were the weakest animal, and this guy made them pay. And that's just.
A lot of people probably don't understand this. So if I own a position stock that's long, there's not much you can do to hurt me. You can't sell the whole share you have. But for the benefit of people, because I'm short, there's a lot of other things are short. Even without a view on where the stock should be fundamentally, walk through the class how you can actually make a lot of money by just manipulating.
Well, like a Conseco, take a Conseco when it's $5 or $6. Or often, if its news is out of the way, and sometimes people are short for the quarter because they think it's going to be bad news, and maybe the news is not so bad, or the news is bad, but then it's out of the way, so there's no more news flow. So then it's just, and you can't. A lot of times, if you've borrowed as much as, there's no more borrow. A lot of times, by the way, I don't think I said that, but a lot of times you can't borrow any more of a stock. If there's no more stock to borrow, then you can't short it because the brokerage firms are all out of it. They won't lend anymore. So nobody's there to short it. Nobody's there to sell it. and the buyers just have free reign. And so what happens with some of these guys, and they don't, it's probably collusion, and it's probably, I don't even know if it's illegal, but these buyers will, a guy at Fidelity will call a guy at Putnam, who will call a guy at Hancock, and the next thing you know, like, well, we'd be buying some Conseco. Sounds good to me. And the next thing you know, these guys are putting in massive orders, and there's nothing you can do except decide, do you want to just stay there? Oh, sequel to Conseco, by the way, I meant to tell you this. Stock went 5 or 6 to 10 or 12 fairly quickly. We were getting out the whole way. Stock went to 18 or 19. And Gary Wendt pocketed his $100 million. Within 18 months, zero. Goose egg. It went zero. I mean, God could not save Conseco. It was so bad. And I think Gary Wendt knew he couldn't either, but he just took the $100 million and made off like a bandit. We made a little money on the way back, but let me tell you, it's hard shorting something. After you've just been, completely run over. We shorted some like from 10 or 11 or 12 to down to 4 or 5 and made some of our money back, but it was just, if we put a Conseco stock certificate on our wall, it would be on the wall of shame for sure, not the wall of...
So with that 5, and a lot of people are short, and these guys get together and just decide to buy it.
They just buy it. So there's no sellers.
Goes up to 6 and goes up to
there's
7.
no sellers.
Short is
the short guys just, and again, it's not just that you're losing money. It's not just that you're losing money. It's getting a bigger position. So you're looking at if you have a big position, if you have some people are very tough. You learn what kind of pain threshold you have on the short side. Some people may have, let's say you have a 1% position, the stock may triple. I know a guy that's just a great investor that he doesn't budge. I mean, he'll take it from 1 to 3%, and so that's crazy because I'm going to make 3%. It's going to go to 0 and I'll make it. But if you have a 10% position, and we were bigger than that, because we thought it was timely. We rarely do that. We do that. I didn't talk about position sizes, but on the shorts nowadays, we rarely get over 2%. In the old days, we would get 3, 4, 5% on our big positions, and occasionally really big when we thought it was timely and we were real convinced we knew. But if you have a 10% position and they double it, you've got 20%, and you can't. You're going to get margin calls. You're going to get redemptions because your performance is going to be so bad. You're going to get just lots of bad things. So you have to be really prudent with the sizes on the short side.
So what everybody's done when the shorts are covering, they're bidding the price up even faster.
Right, right. Let me run through some charts just quick, see if I got anything interesting. Cisco, and again, this is kind of the NASDAQ. This is Cisco, and this was the NASDAQ. Remember I told you what the NASDAQ, with all that compounding interest stuff that bored you guys to tears? Okay, well, that's kind of what the NASDAQ did too. Very same thing. Went way up, came back, and it's still not nearly where it was. But Cisco, you can see, was a great growth stock for a number of years. Apple, now, in investing often, if you just know something that it can be an insight that is not that dramatic, but it's just something that the average guy doesn't appreciate. How many people own an iPod? How many people bought an iPod at least 3 years ago? I'll bet you a number of you knew, hey, you know what? This is a great thing. This is really a great thing, and the world's going to come around to this is a great thing. Well, guess what? It was. It is a great thing. This stock, you could have bought this stock in the middle of 2004 at $10 or $12 on its way to $200. You could have taken out a student loan and said, Dad, I'm not putting in my tuition. I'm putting in Apple. And you made 15 times, close to 20 times your money in that. Just because the iPod was so great. And of course, now they got the iPhone out. Now this one's corrected pretty nicely. I'm not sure, in the scheme of things, I'm not sure what it is now. But just that one insight would have done that. Google, this shows, again, Google, when Google came public, it actually came public at 75 only, what is that? Only 3 years ago, two to 3 years ago. And quickly first started trading at around 100, went from 100 to 700. And I guarantee you, most people in this room would have said, Google's great. And it's sort of the stock's gotten whacked pretty good lately, you can see, 700 to 400. But it is kind of it's what Microsoft, it's what keeps Bill Gates up at night. I mean, Google is kind of the new Microsoft because they have the world by the tail right now. And Microsoft is kind of an old, tired company at this point. There's Monsanto. Again, this is just the agriculture theme. And that's a growth stock. It continues to sell at a high multiple, but you can see this one's gone from, 15 at the beginning of 04 to 120, 100. It was up yesterday and today. It's probably getting close to 110 again. But a nice little 7-8 bagger. Potash, same thing. These guys do fertilizer. These guys have a tremendous amount of resources. Pricing, and we've owned this one. This has been our killer stock for the last year and a half or so. This stock's more than tripled in a year and a half. And really what they have is they do fertilizer. And what they have is more reserves in Canada than just about anywhere else. And huge pricing power. The price per ton this year is going to roughly double. The Chinese are big buyers of this. And the Chinese, this is just one anecdote that makes you think, that's interesting. The Chinese, 3, 4, 5 months ago, are big buyers of this, and Potash told them the price was going to be X, which was a 20 or 30% increase over what it was, and the Chinese said no. The Chinese are great negotiators. They said no, we're not doing it. And Potash said, fine, because there's only so many guys they can buy from. And the Chinese came back 2, 3 weeks later and said, okay, we'll do it. And now the price is continuing to go up from there, and that's what's happening with this thing. We still like this one. This one's gotten more expensive, but it's still going to be good, we think. We talked about Nautilus. I was going to say something else about Nautilus. I was just going to tell you one quick story about Nautilus because this was funny. The kind of stuff you do on the short side sometimes is really creative. When we were blowing and going, and we had a big staff and all this, and we would hire consultants to do things. And we never want to get. In investing, you want to know the rules, and we didn't like to get close to the edge in terms of insider trading or anything. The best thing to do is know where the edge is and not even get close to it because it's too good of a business. You can make too much money without worrying about trying to trade on something special. But you can also be creative and be innovative. Nautilus they had a big season when you think about it. Christmas was a huge season for them, and they only had 2 main warehouses where they shipped all their machines out of, the Bowflex. So what do? Well, we hired a guy to go, take up a position in some truck somewhere with his binoculars and count the trucks that were leaving during the key shipping season. So he's telling us how many trucks, and we're getting a week to week, we're getting a comparison. The funny thing about this was the analyst who was working on this at the time, the stock started going down, and the analyst was on the chat board. He was on the chat room with his stock. And there was a guy, so even though that the company's making all these bullish statements, our analyst is on the chat room, and he got really scared because one of the guys that was talking said, because the stock's went down, he said, I don't know what's going on here, but I know the shorts know more than we do. They probably have somebody in a truck counting the shipped trucks that are leaving. And Chad came into my office. He was white. He's like, I think we got to call him off. But sure enough, that was. Again, this is one where you could see it in their numbers too, that the cost of goods were going up. What is that? This is just an example of, that's countrywide. This is just what's happened with the mortgage business. And this is another reason to show you how tough it is to short. We tried shorting some of this in the end of 2002 because of the same reason that all these things came unglued, that it was overdone, there was too easy credit, that these things were going to come, so for 3 or 4 years, I can tell you the short sellers were on these mortgage stocks for 3 or 4 years, which is why when it finally came undone, they made money, but there were a lot of them that didn't, like us. We made some money, but we didn't make nearly as much as we thought we would in the beginning because it took so long, and it didn't hurt you a lot, but hurt you in the early going, and then it was kind of up and down, up and down. But when they came unglued, there you go. Why did I put that one? That's Clean Harbors. That was I think I put that one in. That's an example of a stock where margin improvement. Pricing gets at margins. Margins are really key. And these guys just these guys do environmental waste cleanup, and they were really improving their margin, and they told you they were going to do it, and they did, and you could see it in their numbers, and it just kept happening. A friend of mine, I have a friend who used to be at Tiger who now is running a firm called Viking that's probably $7-8 billion, really successful, really smart guy. He made a lot of money in Tiger on here was his simple thesis. He's from Norway, so he spent a lot of time in Europe, he was doing a lot of European stocks. And there were a lot of European stocks at the time that were sort of down and out, big conglomerates, banks, industrial companies, whose margins were much lower than their American counterparts because they were so bloated, their costs were so much. Well, a number of these companies started getting in CEOs who were killers. And you could meet with them and you could see they were killers. And they were saying, we're going to raise the margin. And they did. And he just bought a package of these things, and these stocks went up 3, 4, or 5 times. Just a very simple theme, but you could see it playing out. NASDAQ, these exchanges, this is an example of something. Sometimes you find companies that are misunderstood. Nobody realized when the NASDAQ, when these companies started coming public, how much cash they threw off, how much cash they generated. This was another thing this was a good one for us. We started buying this at $12, $15 and stock, pretty quickly ran to 45 because it was a growth company with great cash flow characteristics, and nobody really appreciated that. And there's Bear Stearns, which was a great stock for a lot of years. That's just a pretty wild chart when you see something like that. So just quickly, I'll just tell you, just in terms of, it sounds like a number of you may be interested in getting a job in the investment business. One of the nice things about this business is it's really easy to see who's good or not. It's whether your stocks work. And so, I will tell you that the hard part about this business is getting a seat, getting a spot at the table, because people don't hire very often. They don't hire many people. It's not like they don't have analyst programs where they're hiring dozens of people every year, but they do hire. Investment firms do hire. They're looking for sharp people. You need to either get in front of people, you need to network, but you can make recommendations about stocks. Why you think they're going to go up, why you think they're going to go down, and why. And that's compelling to people. I mean, I'm telling you, I read the craziest things from people. I won't even tell you, since we're running out of time, I won't tell you the story I got to lately, but I'm looking at something pretty hard as a private investment that came to me from a former baker who left town and went to another town. She makes cakes, but she's gotten to know this guy that's doing something that doubles your gas mileage. But people, I'm no different than a lot of people in the investment business. Portfolio managers are dying for good ideas, and most of them don't care what they get, where they come from. So you have a chance with ideas that work, because when I look at one idea that works, and I always want to know, were they right for the right reason? But when somebody's right for the right reason, that's very interesting. I probably didn't buy it, maybe didn't do anything, but I notice, I keep track of that. When somebody is right for the right reason a second time, I'm thinking, I want to talk to this person. I want to pay this person. I want their ideas. I want to know what they're thinking and why they're thinking that. So in our business, there are a lot of people that write newsletters who've made a lot of money. There are a lot of people that end up getting spots as analysts because I've got a good friend at Tiger who was at Tiger before he's doing his own fund now, and he was in with a buddy of his, and they were copying something at the copy machine. He was just in they were going to dinner or something. He'd stopped by the office, and so his buddy at Tiger they're going to dinner together. And Julian walked by and started talking to the other guy who's not there and says, what do you think? What do you like? What do you like? Why do you like them? And he started rattling off his ideas, and here's Julian, the successful, prominent hedge fund guy and manager in the world, who said, wow, those sound like really good ideas. Come back and talk to me. And he hired him. And he was, he ended up being a guy that made Julian a ton of money and made himself money as well. So my point there is you can get your ideas in front of people who have money. There's lots of people with assets out there. There's lots of people who want ideas. I'll give you my email. I can't promise you that I'll send something back promptly, but I can tell you. And Dr. Brown and I were talking about this earlier. I mean, I told him, I said, I've got a good friend who has been teaching classes at UVA. Very successful hedge fund guy. He's made a killing. He's really a quality guy, neat guy. He teaches at UVA. Been doing it for years, and it's kind of a racket because he's hired a couple of people there over the years. And what he does every class, every course, the big project at the end is pitch one idea, either long or short, and give all your work why you like it. Well, inevitably he buys a handful of those ideas, and he and his team look at him and they're like, wow, these are really good, So he gets the benefit. It's a good exercise for the students because they critique him and they explain, you need to do this, you need to do that. So I'll tell you, I will probably send back and say, what about this, what about that, and I like the way you did this, or I didn't like the way you did that. And I may even buy it, who knows, or short it. But, so, yeah, or I'll tell you why they're wrong. Yeah, I meant short it if you say it's a short, but, so my email, if you wanted to send me something, and again, I'm not promising, it depends on how, part of the reason I gave our money back is so I can go do some fun stuff and hang out and all that, but I still tend to go to my office every day and work. So my email is Thad, T-H-A-D, at trinitycapital.net. Thad at trinitycapital.net. So I would, again, I would encourage you that it's really a fun business. You can do it the way you want. It's just, you learn a lot. It's a great way.
What do you think about, people have some different opinions on this, but managing your own money, or maybe a few small amounts for some friends and families, and sort of carefully documenting your performance and what you own and when you bought it, when you sell it?
Yeah, it's good. It's good. That definitely, and you can even audit it if you want. But as long as you have somebody who knows what they're, you document it, right, then that's good. That you can. What he's asking is there how many, does that count as keeping a record, as getting a record going? And it does. It's not quite the same as doing it with real money because it's easier to get in and out. But it's definitely better to do it real money than, say, paper. You don't want to do paper trades where you're saying I would have bought it here and I would have sold it there. Even if it's a small amount of money, you want real money at stake so you can say, I had the cost of the friction costs, commissions. I had to buy it here, I had to sell it there, that sort of thing. But no, that gets you a portfolio and can get you a record that people can look at. Questions?
What are the best 3 books you've read as far as business investing?
Good question. Bernard Baruch is an interesting guy, and if you can get a hold of Reminiscences of a Stock Operator, I think it's out of print, but if you're creative, you can find it. Reminiscence of a Stock Operator, that's a fun book. There's also Jim Grant is a guy that writes a newsletter that's really good. Jim Grant is really witty and really sarcastic and very funny. He wrote one about Bernard Baruch. I think it's called The Making of an American Legend or something. But Jim Grant's book on him is good. The Buffett book I mentioned, the Buffett book by Roger Lowenstein, it's really a great read. It's a fascinating book. You'll like that one. When Genius Failed, I think is good. Genius Failed is fun, but because it's about that whole long-term capital collapse and what's going on. A better book in terms of investing. One of the ones I'll put actually closer to the top of the list, just on investors, is John Train wrote a book called The Money Masters, and it's got chapters on lots of different guys, and it's fun because you'll identify with some. You read that book and you'll get a feel for a lot of different types of investors, and you'll identify with some of them. I think he wrote a second one that's also pretty good. The Market Wizards or something is another one, but the Money Masters, his original Money Masters, is a really good book. Yeah.
You spoke a lot about opportunities presented by the gold markets in China and the Middle East. Are you worried about possible detrimental effects to our economy from rising commodity prices and from increasing trade deficit and things like that?
One word, absolutely. Yeah, I am. And that could smack our market. I'm not sure if our market, how much risk is in our market, because I worry about our currency big time. I think. Yeah, I talked about gold. I think gold is we're going to have a run on gold here at some point because people realize the Fed's going to do whatever it can to save the economy, to try to keep housing, prevent it from being so bad. I think the Chinese are going to wake up some point and just stop buying treasuries. And when they do that, we got a problem. I think it's about $2 billion a day that comes into our country to help finance our economy. And I think it's going to stop. And I think it may start going the other way. Now, for now, I talk about our market because as their currency gets stronger relative to our currency, they can buy our assets, they can buy our stock, companies in our stock market. There's going to be more and more takeovers. So that's a counterbalancing impact on our stock market. as our currency gets hit, it's easier and easier for people to do takeovers. So for all you M&A investment banking guys, there's going to be business. There's going to be a lot of business out there. That's going to happen. But it's a balance too, because these other countries, they don't want their currencies to get too strong relative to us, or then they can't trade. They can't export. We can't afford to buy anything. So, yeah, I worry a lot about it, and a lot smarter guys than I are trying to figure that out. And I'm not sure. I mean, I try to focus on sort of what the A plays are for us, how we can take advantage of that. Oil is one of them right now, I think. But that's an issue. That's going to keep going. All right. Oh, one more.
I understand that in China, they are lacking in transparency laws and most of their firms. How does that affect you as an investor?
Say that again. Lack of transparency?
In China, I understand that the firms and businesses there are lacking in transparency.
Yes.
How does that?
That's a good question. It does impact. I mean, and different countries over there do different things. I went to a conference in Singapore last May and just came back. The other thing I didn't say about some of these investments in some of these emerging economies, now they've all gotten whacked pretty good, 20 to 30%, China, India. But I'm telling you, I went over there last May and was amazed because I got to see face-to-face some of these investment teams, the management teams, and talk to them and see what they're doing and seeing how they're growing. And they've gotten these guys that are growing at big rates with 30% return on equity numbers, and the stock's selling fairly cheaply. And I'm like, oh my gosh, why am I even bothering investing here? There's so many opportunities. We always put a certain amount of a discount on foreign stocks because of things like what you're talking about. You don't get the transparency necessarily. You can't rely on the accounting rules always. So it's trickier. It's harder. You want more of a margin of safety. I mean, I think we would like to see it even be more compelling if we feel like we're going to invest in something. And we worry about some countries. I mean, I got a friend who believes in concentrated bets, which we tend to as well. He put 10-12% of his assets a number of years ago in an Eastern European media company. I think it was a radio or TV station, because the numbers were so good. Well, guess what? I can't even remember which Eastern European country it was, but it was 6-8 years ago, still communist controlled at that point, whenever it was, 10 years. Well, he thought the numbers were great. So did the government. They basically took it over, and just snatched it from the shareholders, went to zero. And what do you do there? So, you want to be in countries where you feel like they're investor friendly somehow. Russia's tricky. It looks compelling sometimes, like right now, but you got to watch it. So that's a longer issue. That's a whole class of a discussion probably. But it is something that, for us at least, is not keeping us from investing in some of these things, but it does make you take a hard look at it. Okay, thanks a lot.